2-hour, same thing. Don't chase it. So, this is what I've been looking for. I said towards the end of June, so it's stretched out another week. But thank you, Ben. Anyway, so you're not too late. It's just the beginning, but sell rips. Don't just launch here. And anyone that was holding their stocks because they didn't want to take capital gains should reconsider. Because before it's all over, I know it's a big call, but my target for this move in the S&Ps, because of euro. Okay. Let's see what it will take for, yeah, well, that's because there's risk off. I think there was something about the euro. The 2-week off numbers here, we're not that far away now. 42.87, we're right there for a potential 2-week reversal. And I do believe we took out last week's high, 43.62. Yep. So if we take out last week's low, 42.74, we'll have an outside candle. It'll be the second one. This reversal didn't work. I think this one will. Japanese yen broke down big time. Drew this formation under 1040 measures. We're almost there, 920. I think we're going to 170. And CAD is exploding. Up another 86. I drew this as an ascending triangle yesterday. There were a few attempts, but once we had a close above it, looks pretty good. 127.50 on its way. Okay, so any questions? Yes. And you know, it was interesting, and I missed this because the euro was making new lows, and I was waiting for one more high for a 3 drive in US dollar Swiss. Had orders in last night above this high, never got there. So this was kind of a market tell. While euro was making new lows by 40, 50 pips, US dollar Swiss could not. And if it did, it was going to be a 3 drive, but didn't happen. Okay, so I believe Stell's going to come in and
Good morning.
share his thoughts with the room. Good morning, my trading warrior brother. How are you?
Good morning.
I'm very
Good
well.
morning,
Hey,
Steve. Volgi. Little gravity today.
Yeah, isn't it amazing that the market is actually now responding to the hour of when Blake is going on holidays? Isn't it amazing?
Yeah.
He announced, "Oh yeah, I'm going on holidays," and I just went.
they put a note.
Yeah, exactly. Let me take the screen. Okay, so we got risk off obviously today. It seems to be going across the board.
Any idea why?
No, and it started yesterday, right? So
my guess is Japan in a state of emergency in front of the Olympics.
Well, it's definitely not a good thing, but I don't think it's going to be affecting global markets. No.
To be honest, I said yesterday in the chat room when we got the initial comments, right? There were some comments as expected that were, somewhat, let's say, less dovish than we expected. What surprised me was that the initial reaction in the dollar was rather muted. We even had just a tiny bit of a sell-off, which I didn't expect. And equities just didn't care about it. Now,
you're talking about the FOMC, right?
The FOMC minutes. Yeah. Now, the weird thing is that today we get the reaction that I would expect if I had the statements, the minutes from yesterday, but so far we don't really see, a big reaction from the dollar. Yes, against commodity currencies, the dollar is stronger, Um, uh, and it should be noted. So at least this correlation works. And we finally seem to have reverted back to a normal correlation between
stocks and
yields.
bonds. Yes.
Yes, between yields or bonds, if you want to look at it like that, and stocks. Because weirdly enough, and we said that this can't last for much longer. Usually it lasts for short periods of time. We had this weird situation where bonds had started being more or less uncorrelated or even slightly inversely correlated with stocks. Yields in this case, actually, with stocks.
Well, they've been the old normal, which was stocks go up, bonds go down, or vice versa, that has stopped being the case since 2008 or 2009. So I don't see why this correlation cannot continue to the downside. So stocks down, bonds down. But like you said, at some point we're going to have to go back to the way it should be. You know, higher yields, you know, lower stocks, and lower yields, lower stocks. You know, as when risk-off sentiment comes, the first reaction is to buy bonds, buy treasuries. Yeah. You know, it's safe.
Pavlovian reaction.
Yes, yes. So you know, it's a very interesting reaction, and it's a very interesting move. However, you know, you look at the S&P chart. Oh yes, we're going down quite fast. If you go down, this is a 1 hour. You go to the 1 day. You know, it's a blip. You know, you know. This is my fault. I always tend to look at the bigger picture. I'm not a day trader, and everybody knows that. But you know, it's if you look at this, it's still just a tiny correction, and I stand by what I said before. If we don't see yields rising, I don't think a move lower has any legs. Obviously, we can get to 4,100 or test these lows. Of course, this will take us a couple of months back, basically. But you know, for a proper correction, I looked at your chart, Dale, before. Target was something like 3,500 or 3.2 or whatever it was. I mean, for such a move, I think we need to see yields going higher. But anyway, you know, I don't want to say the same things over and over again. Interestingly, okay, the FOMC minutes yesterday was slightly disappointing. We didn't get that much new information. I guess the market now waits for the next FOMC meeting, or maybe September.
Yeah, as I said before, though, some of the comments, as we expected, Stelio, were less dovish than than market participants would hope for. Let's say, you know, the stock participants. Yeah.
Yes. On the other hand, we had the ECB today, who I'm sure you saw that.
I did. I did.
From having a target of just below 2% or at 2%, they're going to go to a symmetric target, and
everybody following each other. Still, we've seen that before.
They use the word. They said we may have a transitory period of moderately target CPI. I mean, you can't make this up. So
literally, you can't.
They're gonna allow inflation to climb a little bit higher for a little bit longer.
And now the most amazing part of all: what is the reaction of Euro to the announcement that they will tolerate a higher rate of depreciating their currency?
That's the best part. Crazy, right?
It is just, I mean, if you wrote all these things down in a list and gave it to somebody 20 years ago, they would call you crazy, right?
Yeah. But anyway, this is what they're telling us. They also said that they're going to include owner-occupier housing in their inflation calculation, which is good because this is going to push it higher, theoretically.
Yeah.
So,
although Stelio, I've explained before in a completely random time, not a long time ago, that this metric is somewhat broken. We used to have rent prices.
Yes.
In the US, they used to have rent prices in the calculation, the CPI calculation, and then they transformed it to owner-occupied. Which is asking people, which is not the same thing, of course. Like, if you had to rent your house, how much would you be paying?
I mean, why take the market, right? The market is a price for it. Why take that?
Exactly. I mean, instead of taking actual rent prices, which is very easy to do, right? You're asking owners how much they think they would pay to rent their house.
Yeah, well, only central bankers can answer that question, why that's happening. But anyway, so that's what the ECB said. Actually, they also added that they are going to be adding climate change considerations to monetary policy. So basically, if we get warmer climate, or if we go higher by like 1 degree or something, let's print some more
Yes,
money.
absolutely. Absolutely.
You have to laugh, but anyway,
No,
it
you
is
know
what it
something,
is.
this is not something to laugh with, because it goes far beyond that. It goes far beyond ridiculous or anything else. If you asked any central banker like 20 years ago, right, if that would be the job or the business of any central bank, they would laugh you out of the door, right?
Yeah.
I mean, theoretically speaking, more than 95% of central banks on the planet have one mandate only: inflation, right?
Yeah. Yeah.
So how the hell, and even the Fed has a dual mandate, but the second mandate being
Employment.
employment.
Yes.
How the hell is any of the two connected with climate change? I'm not saying that climate change, saving the earth and all that is not an issue, but it's like saying, we have, like, let's say, sea turtles dying because of the ocean not being as clean, and that's the job of hairdressers.
And even that mandate, guys, about inflation was to control it from going up, not to um, incentivize it through their policy to make
Yes,
it go up,
absolutely.
right? I
Correct.
mean, so
Yeah.
That
even
is
that's
correct.
not that's not one of their original mandates. Yes,
Yeah.
we need to get inflation higher. Um, I don't recall that in my career.
Yeah.
And even recently, we've even had central bankers being asked about, questions that have to do with racism. I mean, racism is a very serious issue. There's no question about it. How the hell is this the issue of a central banker? I
Yeah.
mean,
We're mixing. Yeah.
can any issue that has some seriousness, or any valid points, be the issue of central banks? Soon enough, there's going to be no need for politics and politicians, right? We're just going to be electing a central banker, and they're going to be taking care of everything.
Yeah, we're mixing, central banking and governments,
And
and
the funniest part of all is that supposedly these institutions are completely independent.
yeah. Well, that's this is a long conversation, but yeah, I agree with you. It doesn't make sense. Anyway, let's move along to the markets. We had some data today, nothing major. German trade balance worse, a little bit worse than expected. Mexican inflation creeping higher, and I think the markets are now expecting another hike in the next meeting, if I'm not mistaken. But really nothing today to write home about. Currencies, you talked about the euro. It is strengthening for some reason, which I don't get. But anyway, I still think the
Dale,
dollar. Yep.
Dom can't read what you wrote because you wrote it to panelists. Dom, your interview is in 15 minutes from now. That's why you're muted.
Yeah.
Dale will unmute you in 15 minutes for the interview.
So
Sorry,
no problem, no problem. So the dollar theoretically should be strengthening today. It is strengthening against commodity currencies. It's not against the euro. I still think there's a good chance that this rally will get towards 94-ish, 94 and a half maybe. But the Aussie, the Kiwi, actually well, let's have a look. They're both reversing. The Aussie is now hitting the 23.6 from this move higher. It's it will depend on how much lower this equities can go, but for the moment, I think a kind of counter trend dollar long is still the way to be, but with a view to be basically selling any decent rallies.
And to be honest, tell you, if the euro was not higher today, which, as I said before, literally it makes zero sense with what euro with what the ECB announced. I mean, theoretically speaking, as we speak, the euro should have been lower than any of the commodity currencies today, just today, because of that, right?
Yeah, theoretically, yeah.
Yeah. So if the euro was acting normally, the DXY would be significantly higher, because everything else, more or less, I mean, the vast majority of commodity currencies are like, down on the day, in essence, following risk assets. So I think that if euro goes back to what it should normally do, we're going to see that
Yeah.
next leg higher we were talking about
Yeah.
in the dollar.
Yes. Metals, interestingly, are resilient, probably because of yields dropping.
Yes.
So they're resilient. Gold is up on the day. So even silver, which usually gets smacked with risk, is only marginally down. So I like that. I still think if the dollar spikes, they're gonna have another little leg lower. But gold potentially could come and test these 1700s. I know it's 100 plus points away, dollars away, but it could still happen. And cryptos are interesting because Bitcoin is now getting close again to the bottom of this channel thingy.
They've had a
Not
bad
channel,
night.
sorry, the bearish flag. Yeah, they've had a bad night. And remember, yesterday I said, look, the more time we spend near this bottom area, the more likely it's going to be that it breaks. And I still think it will break. And with all the levels that we talked about yesterday, 26,000, and if that goes, it's going to be defended. But if that goes, man, I don't know where it's going to go. So it's definitely one to watch Bitcoin, because like we said before, it's big enough now. There's institutional interest in it. So you really want to keep an eye on that, even if you don't trade it, which I don't, but I definitely have them on my radar on a daily basis. We talked about commodity currencies. That was a nice out from your dollar Norway shorts, Steve. You were in those for ages and you were very patient. And then as soon as, this kind of basing pattern looked like it was going, remember, what was it, 8:30 something, you were out, and look, it's climbing again. So
yeah,
well
it was not just like breaking through an important technical level. I saw the momentum behind and I was like, okay, I've had a good run.
Yeah, oh, it was a great run. And I had the position as well, and I got out earlier than you. So well done for sticking it out and getting almost the maximum you could get out of it. That was a really good trade, I thought.
Thanks, mate. It was good. It's because I was patient. It's
Yeah,
the hardest thing to do, and many times I fail as well. But this time I succeeded
that
in
was good.
being as patient as needed.
That was really good. And we talked about yields before. I'm still looking at bunds. This is what I think. This is what I drew a few days ago. I think there's a good chance we might try to hit that upper bound again if we do get anywhere near that. I'll be
Yeah,
shorting
there
them
is
again.
momentum. There is momentum
Yeah.
behind Boons. I told you when we broke that flag down there.
Yes. This one here, right?
Yeah.
Yeah. That one
It
there.
was looking like they want to move higher. Now, sometimes you have to completely forget your fundamental thesis because in the short term, technicals mean a lot more than fundamentals. The market can be
Oh yeah.
stupid
Yeah.
for much
Yeah,
longer.
because you weren't looking for yields to drop this much, Steve, were you? You didn't think they would, did you?
I expected first of all the bond to move higher, much higher than the treasuries because momentum was different, having to do with
10-year.
treasury yields, if that's what you mean. Treasury yields are currently testing the trend line support of the channel I was looking at. So it
Which one is
breaks
that?
through.
Shall I give the screen?
Yeah. Let me grab the screen. I
Yeah.
have a few things to show since you mentioned it. So yeah, here it is.
I just want to let our viewers know I'm not right about everything all the time.
Me neither.
So here it is, Dale. Currently trying to break through this trend line support. So up until yesterday, they were still playing ball with what I was looking for. Now, if today they keep moving lower, then we break through this, and then it's a totally different ball game. You see?
Think we could get to 110 or maybe
if we break
1%?
Through this trend line support, then yes, we open up lower targets, 120 being the first one, and then we in essence open the 1% area for a retest, right?
Okay.
Still though, I'm as long as we're not closing on a daily basis below this channel, I'm not changing my bias. Of course, if we see a continuation of the risk off, I'm assuming that yields will drop below it. And since we're talking about yields and we mentioned it before, here is the S&P with the 10-year yields. You can see how rather good the correlation is. And you can see that now we've created this big gap, right? And in my opinion, sooner rather than later, it has to be filled. Now, the question is today's move in equities the beginning of closing this gap? It might be. So if that's the case, you see that there is a lot of catching up equities can do with yields. And here's the Nasdaq against the 10-year yields. Also, you can see that we've created like a big distance between the two
Yeah,
of
that
them.
has to be filled one way or another. So either yields go up or equities go down.
Yes, exactly. So I think that today might be signaling that some kind of a reversion to, you know, to matching up the two of them might be happening, which means that it might be the beginning of an interesting move in the markets. We all know how overdone things were, and I did say yesterday that at some point during the summer, I do believe we're going to see like a sharp corrective move in equities. Who knows? It might be starting today, right? With a little bit of a delay from yesterday's FOMC minutes. Perhaps too many traders were watching the England game yesterday, and they were like, you know, F it. I'm going to trade it tomorrow.
Did you see the quote somebody wrote on Twitter? I don't think I've seen sterling fall so hard since Brexit.
Yeah, that was actually amazing. And to be honest, I wrote it on Twitter. It was my only comment. You know, just 10 seconds going into football. You know, Denmark played really badly during the last 50% of the match, and they just try to preserve the score, which I really don't like, and they didn't deserve to go to the final. But that penalty was ridiculous. I mean,
Yeah,
especially in the era of VAR.
yeah.
I can't believe that they saw this in VAR and they said, "Yeah, sure, this is a penalty." I mean, this was a disgrace.
Yeah.
In any
Anyway,
case,
yeah,
I'm happy England passed because we're going to see a nice final. I think it's going
yeah,
to be a nice final, Italy versus
agreed.
England. But
Okay.
it should have been done in a different way.
Mhm.
So speaking of the indices, as we said before, yes, I think we might try to do some catching up with the yields. And as I also said before, if you look at commodity currencies, here's the Aussie, here's the Kiwi. Kiwi, by the way, seems to be about to break through this little corrective flag, which points to another leg lower. I'm assuming towards the bottom of this larger corrective channel. So I wouldn't be surprised to see a move towards 67 and a half, 68 cents. Also, we mentioned yesterday that USD CAD and USD NOK were in symmetrical triangles, which pointed to further strength. And here it is, USD CAD broken out, USD NOK broken out. In essence, 890 is my next target in USD NOK, and in USD CAD, 2740, 2750 is my next target.
I'm praying for a nice spike in USD NOK and Euro NOK to get into shorts again.
Oh yeah, I think we're getting that as we speak, Stelio. So let's also fib extend this. Let's see what target we get. So yeah, 892 equality target of the first leg higher with the second leg higher. I wouldn't be even surprised if we see a bigger extension. So bottom line, we expected one way or another that we're going to see another leg higher in the dollar. I think we've already seen this happening. Now, I know that the DXY is not confirming, but as we said before, it's almost exclusively due to the DXY skewed in favor of the euro, right? The biggest contributor in the DXY is the euro. So this peculiar move from the euro higher, and I'm calling it peculiar as I explained before, because the change in policy from the ECB in any economic sense should have been euro negative,
Yeah.
right? And for some reason, we're seeing the opposite. Now, ask any economist that actually understands economics, and it's really unexplainable, because in essence, what they say is that they're going to tolerate higher inflation. Higher inflation is, the thing that erodes the value of any currency. So that should have been immediately euro negative. Now, I can't answer why it's euro positive today. I put it in the basket of the things that, in my opinion, are completely unexplainable.
Yeah.
But in all actuality, what I said before, don't look at the DXY specifically today, because what you see is completely skewed by what's happening in the euro. Look at almost any other currency against the dollar, and you'll see that we've started another leg higher, in essence, in the dollar, right? So let's hope, and close with that because Dale has his interview. Let's hope that this is not going to be another head fake, meaning it's not going to be another uh, firecracker of a volatility type of event that's going to last like 24 hours, 48 hours. And let's hope we're going to be seeing some follow through, and finally some markets that are much better to trade than what we usually lately have, right?
Yeah, it's always good to get some two-way
Yes,
action.
especially when Blake is away. That's my that's my best hope for a continuation. That Blake is going to be away by Wednesday.
Do you think he's broken a couple of laptops already or not?
I think he's too busy having fun to break laptops. I think he's going to do it once he's back.
So if Blake stays away till November, do you think the S&P will get down to 25, 2600?
800.
Back
No,
to
2500.
back to 666 if he
Oh,
stays.
back to the mark of the beast? No, not this time. But back to
Oh.
26, 2500. If he stays up there on the houseboat.
As I was saying yesterday, and I'm not changing my mind, Dale. Unfortunately, I'm not that optimistic, having to do with too much
About being
volatility,
bearish.
because we know how much this is not a, let's say, a controlled market, right? I mean, they pay so much importance to that. Your guest yesterday, which is
Yeah.
a very experienced guy, right?
Yeah, he
Even
said they'd engineer a
yeah,
decline.
you even said that it's the stock market is so important, right?
Yeah.
Even to the Republicans that are not currently in government, that a decent move lower in the indices might be enough to get some
Republican
agreement.
support for
Yeah,
spending.
agreement and the Republican support to
Yeah.
increase spending. Just imagine that.
Amazing.
Yeah.
Amazing.
Yeah.
So that maybe Paul heard Harold yesterday. So anyway, Harold's full of wisdom. I mean, so many different presidential administration he has served in different roles.
U.S.
So.
initial, sorry to interrupt, Dale. U.S. initial jobless claims 373 versus 350, so slightly worse. Continued jobless claims more or less as
Same
expected.
number. Yeah.
Um,
Revision slightly lower. Nothing big.
yeah, I mean, slightly worse data, but do I think they're actually going to be moving? I mean, are they out of the mark significantly to actually move the markets now?
Yeah.
Okay.
Great.
Okay.
Thank you,
Enjoy the
guys.
Thank you,
interview,
Steve.
and as
Okay.
always, we'll be here in 45 minutes, right?
Okay, join the team for the Morning Edge, and Dom, welcome back, buddy.
How you
How are
doing,
you?
Dale? Yeah, good to listen to the guys, and good to be on.
Yeah, there's no shortage of banter here in Face, so yeah, no one's shy. Everyone likes the microphone here. So if you want to go ahead and share your screen, Dom, we could take a look at what's on your radar.
Or even his camera if you want. So
Yeah. You want to share your camera, or
you want to see me face to face, dude? Let me put my screen up for now. Hold on, just 2 seconds. So, I mean, I tell you what I thought.
I'm here.
Yeah, I tell you what I thought was.
It's only 5:30 here.
It's only 5:30.
Yeah, I didn't go to the beauty shop.
You look good.
I haven't been to the beauty shop yet, man.
It's been an interesting conversation. I just wanted to just pull out a couple of points in terms of the CPI, the divergences across the markets are just insane, right? I mean, I've never seen anything like this in my career. particularly trading the equity markets, the value growth, the growth value, every day.
Yeah, the rotation, you mean?
The rotation is, and it's almost like instant rotation, to extreme rotation, and you can see it, like even just drilling down to like 5-minute charts. I mean, yesterday the NQ came off slightly, Dow was up like 150 points. It's instant, and it's just, I always when I see things like this and the overall kind of divergences in the market, I just think this is a topping process. And I was saying to my guys on the channel yesterday, like when you get, I call it kind of the 3-day rule. Day one, market comes down. So, you had ES come down from like 350 to 304. Second day, and then bought instantly all the way back up. Second day, come in, did exactly the same. Went down to 320, 50 back fib, instantly back up for the minutes. And then the third day, it just, it will come in and it just won't, it won't bounce. It will just go down and down and down. And that's what it's doing today. And it's just, in terms of the FOMC minutes, if the market cannot understand what's going on at the moment, then we've got a severe problem. I mean, it's massively communicated in not only in the minutes, but also in the speeches and everything, from Powell and the rest of the gang, that, essentially they really don't want to taper, and they will taper as, whenever they want to, and they will want higher inflation first, and that needs to be persistent, and so forth and so forth. And at the same time, they're talking about transitory inflation rather than persistent inflation. And the market, in terms of liquidity and in terms of interest rates, has never had it so good. So I do find today rather strange. I don't, the narrative that the FOMC is somewhat of a surprise shouldn't be, because they seem to explain at every single meeting what they want to do and where they want to go. I find the divergences between the bond market and a kind of reality in terms of inflation insane. I really don't understand what bonds are doing at the moment. I mean, they seem to be completely negating any form of growth, with yields going lower, prices going higher. That's very strange, particularly when you're looking at inflation. So, they're just, the market seems to be pricing in the fact that this will be transitory and inflation will go back below 2%. Why you're buying a bond at 120 when you've got, 4% inflation is just bizarre.
Okay, so here I am, Dom. I have 50K. How do I deploy it?
How do you deploy it? Buy puts, I think. I mean, it's just very difficult. I mean, do you want to buy an equity market that's gone 100% up in a year, when no one's been working?
No, I want to short it.
Yeah, absolutely. But trying to short this market is just incredibly difficult. Right? I know.
I've done it. I've been stopped out at 100 million times.
Yeah.
Sometimes they work, and you never know if it's going to be the top or a top.
Yeah. I mean, if you're a swing short, it's the most frustrating game at the moment, right?
Anthony's saying put the 50K back in my pocket. So cash is a position too. So maybe what we have to do here, what happens here is you're talking about the rotation from one sector to another sector, because people are afraid to be out of the market, out of stocks. Maybe they could find a better performing group. The bottom probably comes when they stop rotating and they go to cash, which is a position too, on a capitulation move.
Yeah, exactly. And for me, rotation is always a sign of the highs. Right? Anyone who really talks about rotation at highs, and I think you mentioned about the Russell. It's been extremely choppy over the last.
Well, I mean, look, it hasn't made a new high. It hasn't made a new high since March 21st.
Yeah. Exactly.
Okay, so do you have any fundamental reason why the Russell 2000 just stalled and moved sideways while the other indices?
So you know, I look at a bigger time frame here, guys. Here's the Russell on a monthly, right? This goes back to 2008. Okay, you can see this channel, top line, bottom line here, right? And obviously we broke out of it in March. I mean, just look at that insane ramp, right? It's ridiculous. But the top line here, 2007.
This is
You know,
not the Russell.
it is
It's still the
Russell.
S&P.
Okay, apologies.
Maybe you have to do a new share
Yeah,
if
I
you're
didn't realize.
changing
Okay, new
screens.
share, a new share. Yeah, I didn't
Yeah.
realize. No, I was
Yeah.
trying to put it on the same screen, but okay, but
Well,
so now you're
there,
seeing the Russell.
there you go. Yeah, got it.
So you can see, you know, this is a monthly chart. 2007 highs.
Yeah.
Obviously, we know what happened in 2008. Okay, and you know, where did it max out? Right. I mean, that's you know, it's a 14-year trend line, right? And it just keeps bumping its head. Didn't get there. So I'm looking for the Russell to come in about 2050. That also, there's a fib, I think, about 2064, be the 23.6. Yeah, 256, and potentially down to sort of like the 1700 mark.
That's what I'm looking for.
Yeah. Now, Christ knows when it's going to get there. Obviously, this is on a monthly.
30%, right?
Yeah, exactly. And it's, I mean, we all know it's due a pullback, guys. I mean, we've all been saying
But
it
why?
each week.
Why have you know, we're talking about economic growth that's going to be fantastic here in the US. These are domestic issues mainly. So they don't benefit from a weaker dollar like the multinationals do. Why has the Russell been stalling the way it has?
Because I think it's up against that trend line. I don't know
Okay,
why.
maybe I'm looking
you know,
for a fundamental reason. I know
there is-
all the technicals.
Yeah, but I don't think I don't think you can apply fundamentals in this day and age. I mean, what are fundamentals? You know, I mean, Apple's just gone up sort of like 20% in the last 6 weeks. I mean, it's a 2 trillion market. I mean, you know, it it's just cash. There's 120 billion dollars going into the markets at the moment, right? You've got the banks doing reverse repos. They're giving $1 trillion back to the Fed each night, and you know, you can look. Here's the Russell. I mean, that's just insane. Look at it. I mean, if you were short all these tops, it comes down, it comes back to bite you. It comes down, but comes back to bite you. And I always say, I mean, I said to my guys and to my followers, I just said, guys, you know, there will be a lot of money to be made on shorting the Russell, but no one will make any because you'll be stopped out every single time, right? And you know, it's
you could have just had your stop over the March high, never took it out.
well, true, yeah. But if you did it sensibly and went back to break even, you know, it would just come back and bite you, right? So,
well, if you don't teach
agree.
your students to take partial profits when they have 30, 40 handles in the in the Russell, yeah, they'd be break even. But I mean,
no, I mean, we do. But what I'm saying is, you're looking for the big one, like you just said earlier, right at the beginning. You know, is it this time? Is it this time? Is it this time? You know, this move here.
You know what time it is?
Yeah.
Well, you know when it happens? When you give up on it.
Yeah, absolutely.
After you're grinded out, Mr. Market will grind you to exhaustion so that you know why? Because I've been exhausted many times through this. And especially if you're taking losses, attempting it, the minute you turn your head, Mr. Market will go without you.
Yeah, absolutely. And I think that's why I think, you know, I can't remember who suggested that, you know, July, August, we're going to see some sort of sell-off. I mean, that's been the pattern for the last kind of 3 years. I think you know, we're just due a correction. I mean, there's no more stimulus at the moment. You know, good news is still good news, and bad news is still good news. And that will slightly change. I don't. There's some fundamental things in the market that just seem to be very, very strange. Mainly, why are rates going up? Why are rates going down? Price bond yields going up? I don't understand that, because they're either telling us something that doesn't reflect in the outside world, i.e., you know, growth's going to stall and so on and so on and so on, right? So that's very strange. And I would go back just to guys and talking about inflation. You know, I call the CPI the Consumer Propaganda Index, right? You know, the reason they changed all the indexes was because inflation was too high, right? And interest rates were at 5%. And what they decided to do is completely change all the indexes, started in the UK, in the States, and so forth, right? To remove inflation, right? That was the whole point. They wanted to remove inflation so they could bring down interest rates. And they wanted to bring down interest rates because they knew they were borrowing and borrowing and borrowing and borrowing at a government level. So the irony now is they're trying to increase inflation. But obviously, once the genie's out of the bottle, you just don't know how long it's going to, how far it's going to go. But yeah, it is a propaganda index. It's just laughable in terms of what they put in there, what they don't put in there. And we all know, if you go to the shops, if you look at house prices, if you look at, gas or petrol or anything like that, prices are going up, right? And they're way above 5-6% in the UK. House prices, like 10%, 20% year on year in the States. So it's a farce, right? And it's just a manipulated number to essentially control interest rates, right? And that's how they've essentially nationalized the market. Right? They've just nationalized it, and as some of the guys were saying earlier, right? It's so important now that markets essentially continue to go up. But
Okay. Currencies are a little more difficult to manipulate. You have a view on the dollar. Is this bounce in the dollar just a bear market rally in your view, or is something else starting?
Again, I think, if you remember, I smashed the dollar last time I came on. I said, right, this is where it's going to go, and then it's going to come off, and it was absolutely perfect. I think on the dollar, as I said last time, again, this is a monthly. I look at the higher time frames. You've got this channel that broke out. You've got the highs in sort of like 2001, subsequent kind of lows here at 2011. And if you see, we've got this triangle, and on the fibs here, we've got this 93 level, which is a 38, and then 50 back at kind of that's
96.
100. Yeah, exactly. And so for me, I'm staying well away from the dollar. It's just, I'm long above the trend line from the highs. Which
where's that come in?
That comes in about 97. Okay. And short below the trend lines from the recent lows, which is about 90. All else is just chop, and I just think I think it's very difficult to trade with every central bank trying to kind of manipulate their currencies, and then the interest rate play and so forth, and then the stimulus play as well, particularly on dollar. I just look at the big picture and stay out of the day trading, because I just think it's the only interesting thing is it's obviously below the trend line from its low, right? And that currently comes in about 94.50. But it's I mean, stick a finger in the air, you could have gone long or short at like 92, and you would have been offside, but you wouldn't have lost money if you just kept the thing, right? So it's I think people are thinking below 89s and it goes, but the dollar with always being a safe haven, it's a hard one to call, right? I think
isn't this like an Elliott pattern where it's flat and a double bottom? So there are some pretty dollar bulls that have been looking for, sharply higher. How about the recent sell-off we've had in WTI after a monster bull run, and your view on metals, PMs?
Yeah, so again, we're at the situation, I think, where I don't particularly trade gold. I sometimes I look for for swings, and the reason I do that is because, again, I think it's a very manipulated market from the banks, and so I look for essentially value when it went down to 1750. I don't see it going to 2000. I think it's a controlled market, very hard to trade, so I stay out of it. I think the same's happening to crude now. It's become a political toy. Can we use crude to create inflation? It can't go too high because there's too much inflation, and so on and so on. So I think, and again, there was just 2 days ago there was a fire in Dubai, that the price went up, and then there wasn't an agreement and price comes down and so forth. So you just got to look at the technicals, play the technicals. I think it will probably stay between sort of like $64 and $80, and and doing a lot of chopping around there. And I think gold will probably stay between 1750 and 1850. I don't see. I mean, people have been talking about the reflation trade, particularly on gold, for a long time. It went up to 2000. It came straight back down. It's hung around, and I think people have kind of decided that almost cryptos are kind of where you should be rather than gold, because there's a potential higher return in it. And I think gold, like I say, is somewhat manipulated. So personally, I just look for some value swing trades, small notional, and trade, sort of like
With all due respect, Dom, I've been talking to you for, about, I don't know, 15, 20 minutes. Are you strongly neutral, the whole board?
No, I am waiting for a correction in equities. Okay, I think. Can you see my S&P chart
Yes,
here?
got it.
Yeah. So on the daily, we just broke through this 326 area, so 318 to 316. I'm just looking at the, we were talking about Sal rallies mode.
You want to buy a hard break in equities.
I know.
What level?
So the hard break is 275. So
to
if it breaks
275?
Yeah, 275 is the.
What do you mean? You mean 42.75?
Yeah. Break
okay,
that,
you just said, yeah, I need the whole handle. 42.75.
Or 42.75. If we consistently trade under that, then we'll be selling rallies. And I think we'll be looking to sort of like under 4,000 next move by September. That's what I'm looking for. Could it go higher? Yeah, the chart suggests you can go to 4,400. A little bit plus, and above that there's like a 7,000. But I think it's
I like your monthly target.
Yeah. Well, on the monthly we can come down to, 3,800, and then again that would be a fib move. It's very hard to have any conviction on the sell side, because look at that monthly chart. Look at the wedge. We are this trend line here goes, back to 2002, and we just smashed it. And when we broke out of that 3,740 area, it just 5 months of just ride, and really to be truly kind of looking to sell rallies, you want to be under the 5 SMA on the monthly, right? As a minimum, and that comes in at kind of 4,145, 4,150. So you can't have any conviction in shorts, where okay, look, it's come up, we'll sell it, thank you very much. It comes up, we'll sell it, thank you very much. You can't have that conviction until some of the big levels are just taken out. And what's been happening is we get near or nearabouts them. We just didn't quite touch the trend line here on the wedge. You see, this was.
So how about back inside the wedge, and you have your wedge anchored at about 2,500, and wedges are known to retrace 100% of the move.
Yeah.
Did you know that?
Well, I did. They can. It's very rare. On a monthly
not that
chart.
rare. Not
Really?
that rare for wedges. Maybe in the S&Ps.
Yeah.
But the formation itself, I could show you multiple examples of wedges rising and falling. That wherever you have the wedge line anchored for the full formation, I've seen 100% retracements of
And what time frames? What time frames?
Well, it depends on all time frames.
Yeah,
a chart is a chart. It could be a 15-minute, it could be a monthly. The formation is the same. And most people think that you're going to get a fib retracement off a wedge, and I've seen 100% retracements. Just,
Yeah, I think something has to strike. The trouble is, we're in the Fed's in a do or die situation here, right? The response from sort of like 1998 is drop rates. That was the LCTM, right? The Russians defaulted. LCTM screwed up the banking market. They dropped rates. and start flooding liquidity. Same in 2008, and then it's been constant liquidity and dropping of rates. As soon as we had the taper tantrum in 2014 and 2018, markets dived like 25% in 3 months. So they know, everyone knows that as soon as the word taper happens and we start reducing stuff, even though they're slightly talking about it, basically the market is just saying, you're not going to do it now, you're not going to do it now. It's a game of kind of it's chicken and egg, right? Who's going to pull the lever first? And as soon as they do, markets are coming off. How far would they go? Anyone's guess. And if we are to see, a real true movement, particularly down to 2,500, I would expect essentially the pandemic to rear its head. Right? I just can't see a quick move down there. And even if we did have another pandemic or another kind of natural disaster, what's the default? Well, it's just flood the market with more money, right? So, you've got this since 2008, 2009. You've got this situation whereby if there's anything bad happens, something good comes out of it, which is, quote unquote liquidity. So the market's trained, to take the bad news as well. Actually, we're going to get some free money again. Let's go higher. So it's a difficult one to have. It's a difficult one,
Okay, so Dom, now would be a good time if you'd like to show your website and how people could follow you and be ready to pull the trigger when you come out of your neutral gear.
Yeah, well,
and start pulling the trigger, huh?
Yeah.
Well, I mean, I'm just feeding back to what I've heard. I've heard explanations about why a market may go up or down, but I really haven't heard any conviction about anything in your voice about any instrument at all.
No, I absolutely
so
agree.
You're strongly neutral right now. The board.
I am, yeah. I'm
and
strongly.
That's okay.
Yeah.
That's okay.
The way we play it at the moment, is level to level, right? Do not look for the home runs. Level to level, and take the big trend lines. When they break, you go with them. Use them as resistance, support. The market's been very, as people know, it's been difficult to trade over the last sort of like 8-9 weeks since April. Strong upward bias. I love it when we get a smash down because we go in hard and it's great. So yeah, you can follow me on at Trade Inflection. My website is tradeinflection.com. One of the things I do want to mention is we do stock pick levels, and we've been doing it since January. It's free, and it's basically before the open. It gives you an entry, a target, and a stop, and we're up 63% in the last 6 months. Right? And I think it's 105 trades, 60 plus winners, 30 plus losers.
Mostly intraday and 3 days setup. So,
correct. Exactly.
Okay.
Yeah.
I see that.
That's kind of a new addition, and it's working really well. We're at 67% win ratio, which I think
that's a good hit rate.
Yeah, Steve Cohen said his best traders did over 65%, and we're looking at 67. So
okay,
very good and very conservative. We don't chase AMC and all that crap.
I mean, sometimes the right thing to do is nothing.
Yeah. Well, I think you've got to let the markets tell you, right? You've got to be in tune with the markets. And, like your last panelist was saying, it's difficult. A lot of things fundamentally are not working. And, sit on your hands, because when the right time will come, then, you have
ammo.
Then you can,
you have the ammo. Yeah,
absolutely.
All right, Dom. Well, thanks for your time today, buddy.
Yeah, lovely to speak to you, Dale.
Yeah, and I hope you don't mind. I wasn't trying to give you a hard time. I just, I'm trying to come up with some copy for your interview. You know what I mean?
Yeah, no, it's very rare that I sit on the fence, but at the moment, it's.
Ouch.
I am. My gut feeling is that we're going to see some liquidation break in equities over the next 3 to 6 weeks. Timing is really important. Timing is really important, and start small, build your position, and see how you go.
Okay. Well, listen, Don's a pro. I know for sure he's going to keep you out of trouble, especially if he stays neutral. But I can I can tell he pulls the trigger. All right. Well, and really appreciate you being with us today, my trading warrior brother. We'll reschedule something We'll schedule another one for later in the fall, and
Yeah.
maybe you'll have some conviction, and maybe by the time you come here in the fall, the S&P might be approaching my 3,000 target or so. So that's what I think. We could have we peaked right around the beginning of summer. Spring was a great spring. I'm looking for a rocky summer into the fall. So.
I agree. It's seasonal. It's fine. Yeah, I just think 3,000 is a long way off.
And they want to engineer a sell-off to get the Republicans on board for fiscal stimulus. There's nothing like people's 401ks taking 20-30% hits to get people to call their congressman, Republican or Democrat, to go out and do something about it. Save my IRA.
But Dale, here's the thing. You talk about that, and you're absolutely right. Okay, it's a political, nationalized market. It comes down. Save my IRA. But what happens then, right? Instantaneously, the market will bid it up massively.
Yeah.
Because again, it's a power put, right?
And that's going to be a hell of a buy down there.
Yeah. You got to, exactly. And the trouble is that at 4,000? Is it 3.7? Is it 3.5? Is it 3? Who knows, right? And
2,600.
All right.
No Sir Pinkerts from my intelligence gathering. All right, write it down, buddy.
All right.
And if it doesn't happen, tear it up.
Yeah.
All right. So good joking around with you and looking at your charts. I like your clean look on your charts, Tom. Thanks again.
Take care, my friend. Take care.
All right, everyone. My trading warrior brother Dom at tradeinflection.com is his website. Check him out. And I could tell he's a pro. And that's going to be a wrap, everyone. And we'll see you tomorrow for TGIF to wrap the week. And don't just count your coins and your barrels of oil and your pips and currencies. Count your blessings. And we'll see everyone to wrap the week tomorrow. Adios.
Bye-bye, Dan. Bye-bye.
Thanks, Tom.